massive day for the unemployed. Because South Korea's AI bubble just crashed, and Meerkat does not mean dipped, corrected, or wobbled. He means crashed. Like nuclear Armageddon level crashed. Don't believe me? Let's take a live look at South Korea. Here's what's happening. The Korean stock market, which was the single best performing stock market on planet Earth, briefly the 6th largest in the world, has lost around 40% of its value in just the last 40 days. $2 trillion erased. Circuit breakers have been triggered on back-to-back days this week just to stop the selling. Hundreds of thousands of ordinary young people have had their accounts forcibly liquidated by machines. The finance minister has publicly apologized, and the government is holding emergency meetings. This is the first full-scale AI bubble collapse anywhere in the world, a complete boom and bust, start to finish, and it just played out in one country at breakneck speed. Which makes it the most important preview you will ever get, because the exact same machine, the same trade, the same leverage, the same blind faith is currently running in America, just bigger and slower. Today, Meerkat will walk you through the whole disaster, how it inflated, what popped it, and why Wall Street should be studying South Korea like scripture. Let Meerkat explain. But first, a confession. Meerkat has discovered anime, and he is not handling it with dignity. There is a headband now. There are instant noodles. This Saturday was meant to be a 12-episode marathon, curtains drawn, world muted, and Meerkat got through exactly 1.5 episodes before the phone started going off like a smoke alarm, every message saying the same word, Korea. So Meerkat removed the headband, which took longer than he is prepared to discuss, filled the big teapot, the one reserved for national emergencies, and read everything. Meerkat is not okay. This really is an emergency. Let Meerkat break it all down for you in 3 parts. First, part 1, the rise. How one country turned its entire stock market into a single bet on AI. Part 2, the crash, the fastest destruction of wealth Meerkat has ever charted. And part 3, the preview. Why what happened in Seoul is a dress rehearsal for New York. Settle in. You are not going to watch anything educational otherwise. Part 1, the rise. 12 months ago, South Korea's stock market, the Kospi, began doing something no major market has ever done. It went vertical. At its peak this June, it was up more than 116% in a year, a cheeky doubling of an entire developed country's stock market, while America's S&P 500 managed about 24. Individual stocks went berserk, Samsung up hundreds of percent, SK Hynix at one point up roughly tenfold from its lows. For one shining moment, South Korea leapfrogged into the ranks of the largest stock markets on Earth, worth around $5 trillion, and every global fund manager was suddenly an expert on Seoul. Why? One word: memory. Every AI system on Earth runs on specialized memory chips, and South Korea is the world's memory workshop. 2 companies, Samsung and SK Hynix, dominate the supply of the high-bandwidth memory that AI data centers devour. Memory is where an AI's thinking physically lives, and the appetite of the American build-out was so violent that memory prices went vertical worldwide, which, side note, is why laptops and phones got mysteriously more expensive everywhere this year. You were paying the same bubble a small tribute. So when America's tech giants began spending toward $750 billion a year building AI infrastructure, a river of that money flowed directly into 2 Korean companies, and here is the structural detail that decided everything that followed. Those 2 companies grew until they made up more than half of the entire Korean stock index. Half. Imagine if 2 American companies were half the S&P 500. At that point, you do not have a stock market anymore. You have a 2-horse race with a national flag on it. Buying the Korean index, the boring, sensible, diversified option, had become a leveraged bet on one single global trade, whether American AI spending continues forever. Now add the people. South Korea has around 51 million citizens, and roughly 14 million of them are retail investors. They call themselves ants because one ant is nothing, but 14 million ants can move a market. And you need to understand why they marched in, because it is not greed, it is despair with a trading app. Housing in South Korea has become so expensive that an entire generation concluded they will simply never own a home. The traditional path, job, house, family, is arithmetically closed. So the stock market became the only door left, the last lottery ticket, and the country's own finance influencers told young people exactly that. Get in or get left behind forever. Sound like a familiar emotional state? It should. It is the same cocktail driving every meme stock and cryptomania in the West. A locked-out generation seeking one asymmetric escape. The Koreans just ran it with more conviction and considerably more borrowing. In one documentary, a young investor sitting on gains of over 1,300% explained, face glowing, that she worked in AI and believed in the future. Another would not show her face on camera at all because her family did not know how much leverage she was carrying, a portfolio of $650,000, thick with doubled funds, built on borrowing her parents had never heard of. Hold both of those women in your head, the believer and the hider. Every bubble in history is staffed entirely by those two people. Because here is where it turns properly dark. In May of this year, the South Korean government, watching its citizens' money leak into American stocks, decided to keep the gambling domestic, and regulators approved a cheeky new product, the single stock leveraged ETF. Let Meerkat translate. A fund tied to one company, engineered to deliver 2 times that company's daily move. Stock up 5%, you make 10. And, small print, stock down 5, you lose 10. And these funds are not gentle machines. Behind each one sit banks running enormous daily swap bets, and the fund is contractually forced to rebalance itself every single evening, whatever the market is doing, a detail that will matter enormously in Part 2. Young Koreans inhaled these things. Some even exploited a cheeky 2-day settlement gap in the Korean system to buy funds with money that had not technically arrived yet, phantom cash chasing doubled exposure. One fund tracking double the daily move of SK Hynix swelled to $13 billion, the largest product of its kind on Earth. Margin loans, money borrowed to buy stocks, hit a record 38 trillion won. College students maxed credit lines, office workers put housing deposits into semiconductor funds, and through all of it, the government cheered. Officials celebrated the record highs as a national triumph, proof of Korea's arrival, a geopolitical scoreboard going up and to the right, with the country's own president among the loudest voices encouraging citizens into the market. By June, the best-performing market in the world was being held aloft by borrowed money, concentrated in 2 stocks, amplified by leverage products the state itself had approved and applauded. Every ingredient of every historical disaster, in one bowl, with a lid on, and the chef taking bows. Part 2. The Crash. The Kospi peaked on June 19th at 9,385 points. What follows is the fastest major market collapse of the modern era, and Meerkat wants you to notice that no single villain did it. The bubble was not murdered. It was so fragile that everything killed it at once. First, the smart money started leaving early. Foreign institutions had sold tens of billions of dollars of Korean stocks since spring, over 70 billion by some counts, even while local retail bought 60 billion of it. Read that pairing again. The professionals handed the bag to the ants in broad daylight, and the exchange of hands is right there in the flow data. Part of it was mechanical, global funds raising quick cash to buy into SpaceX's colossal American stock listing. Part of it was structural. SK Hynix itself listed shares in New York in July, raising $26 billion, which meant foreign investors no longer needed to touch Seoul at all to own Korea's crown jewel. And part of it was institutional cold water, when the big index provider MSCI declined to upgrade South Korea to developed market status, waving off an expected $30 billion of automatic passive inflows that never arrived. Then came the news from China, reports that Chinese firms are mass-producing their own advanced chip-making machines, and that a Chinese memory maker had gone public in Shanghai with a debut so violent, it briefly became China's most valuable listed company. For a stock market that is half memory chips, the words cheaper Chinese memory supply are not a headline, they are a diagnosis. Analysts in the region compared it to a Sputnik moment, that cold sensation of looking up and realizing the rival you had contained has been busily building overhead the entire time. And layered on top, from America, a steady drumbeat about circular financing, chip giants guaranteeing hundreds of billions in loans so their own customers can keep buying chips, which made the entire AI demand story, the story Korea's market was priced on, look suspiciously like money doing laps. Any one of those might have caused a correction, but remember what was underneath: record leverage. And leverage does not correct, it cascades. Here is the machine, one turn at a time. Prices dip. Brokers issue margin calls, deposit more cash by morning, or we sell everything you own at whatever price. The forced selling pushes prices lower, which triggers margin calls for the next layer of borrowers, which pushes prices lower. And running alongside, the leveraged funds, which must rebalance every single evening, are mechanically forced to dump shares into every falling market to maintain their ratios, selling on top of the selling. On some days, analysts reportedly estimated the majority of institutional net selling was just these retail products rebalancing themselves off a cliff. Nobody was choosing to sell anymore. The system was selling itself. One college student later described selling everything in the panic at what he called an absolutely ridiculous low, then lying awake, opening his laptop at 3 in the morning, and writing a blog post asking himself why he had done it. Multiply that boy by 1 million accounts, and you have the sound the machine makes from the inside. On July 13th, it broke properly, a Black Monday. Sidecars and circuit breakers, the exchange's emergency brakes, firing repeatedly while over 320,000 retail accounts were forcibly closed in the wave, positions seized and dumped at whatever the screen said. And then, this week, the collapse found another gear. On Monday the 28th, the Kospi fell almost 11% in a single session, Samsung down 13, SK Hynix down 14.65, the 8th circuit breaker of the year. Tuesday, another 6%, the index touching as low as 5,262 during the day, a second consecutive daily halt, from 9,385 to the mid-5,000s. Roughly 40% of the market, $2 trillion, gone in about 40 days. One of the worst collapses in the country's history, faster than 1997, faster than 2008. And hovering above the wreckage, a fresh headwind from Washington. America's new Federal Reserve chairman chose this exact summer to make his debut, and he arrived with a reputation for hard money and a message to match: rates held high, price stability first, no rescue winks. Markets despise expensive money, and global capital responded by doing what it always does when American money pays well: it went home. On the very day of the announcement, American memory maker Micron enjoyed a cheeky 7% rally as billions rotated out of Asia and back into the United States. For Seoul, drowning, the strongest swimmer at the pool decided this was the moment to raise the price of armbands. Now the human ledger, and Meerkat will keep the jokes away from this paragraph because these are the people the machine was fed with. Citi estimates Korean retail traders have lost around 56 trillion won on leveraged products, roughly $38.7 billion. Of the accounts wiped out, over 60% belong to people under 35, the exact generation that was told the market was their last door out. The flagship SK Hynix leveraged fund is down by more than half. A triple-leveraged Korea fund popular abroad fell 80% in under 2 months, and there are reports of people who bought it with mortgage loans. Local news describes canceled dinners and silent offices. Across the whole episode, over 1.2 million retail investors reportedly faced margin calls or forced liquidations, roughly 1 in every 30 people in the country. The president, the same office that spent a year ushering citizens into the market, convened emergency interventions to steady it. The government has announced a national debt counseling hotline, tripled the minimum cash required to trade, froze new leverage products, and the finance minister stood up and offered a cheeky little apology, conceding the leveraged ETFs had been introduced without careful consideration. The products his own regulators approved in May, marketed to the young, detonated by July, apologized for in the same summer. The state built the casino, advertised the casino, and then expressed surprise at the casino. Part 3. The Preview. Now, if you are watching this from America or Europe with a cheeky sense of relief, thinking tragic but foreign, Meerkat needs you to sit forward, or at least reduce your recline, because Part 3 is the entire point of this video. South Korea was not doing something different from America. South Korea was doing the same thing as America, smaller, faster, and with the safety rails removed. It is the speed run, and every component has a larger, slower American twin. Understand the relationship precisely. Korea and America are not running similar trades. They are running the same trade, the same machine, at 2 different speeds. Korea's version was small, fast, and fitted with none of the shock absorbers, so it completed the entire cycle, mania to margin call to ministerial apology, in a single season, while America's version, vast and slow, is still mid-cycle, still inflating, still confident. Which means Seoul this month is not foreign news, it is time travel. Concentration? The top 10 stocks are now 36% of the S&P 500, historically extreme, and nearly all of them are the same single bet, AI. Nvidia sells the chips. Microsoft, Google, Amazon, and Meta buy the chips. Micron and the memory makers feed them, and one company's spending is another company's earnings, round and round. Korea's index was a 2-stock bet on AI. America's index is a 10-stock bet on the same AI. Different dosage. Same drug. Leverage? This is the one that should keep you up past your usual 3 a.m. American margin debt, the official, visible kind, just hit roughly 4.5% of GDP, the highest reading ever recorded, higher than the dot-com peak, higher than 2007. And every previous extreme on that chart, 1968, 1972, 1987, 2007, sat directly in front of a major crash. Worse, that number only counts old-fashioned margin loans. It does not count the leveraged ETFs, the zero-day options, the portfolio margin, the private credit, all the modern plumbing. And yes, those same single-stock leveraged funds that vaporized Korean savings exist in America, holding hundreds of billions, doubled and tripled bets on individual companies, rebalancing every evening by the same rules. Run the arithmetic once, so it lives in you. Hold a tripled fund on a stock that falls 10% in a day, and you have lost 30% by dinner before the fund's own forced evening selling makes tomorrow worse. The mechanism that turns Seoul's dip into a doom loop is pre-installed in New York. It is not a question of whether the machine exists, only of when it gets switched on. And the trigger? Korea has kindly demonstrated that too. Notice what actually started their cascade, not a bankruptcy, not a scandal, merely the suspicion that AI memory spending might slow, plus professionals discreetly heading for the exits while retail bought the dip. Now map that onto America, where the entire market rests on 4 companies spending $750 billion a year on AI infrastructure, where returns on that spending are reportedly sliding year by year, and where investors have begun openly saying the first giant to cut its AI budget will be rewarded for it. And the returns on that mountain of spending are already sagging. The investor who famously called Enron reportedly calculates that the giants were earning about 40 cents of operating income per incremental dollar invested a year and a half ago, about 20 cents today, and trending toward 10. At 10 cents, some chief executive eventually notices they could earn more parking the money in government bonds and says so out loud. Meanwhile, the insiders are behaving exactly as insiders behave near tops. New stock listings this year have arrived at a cheeky record above 12% of GDP in newly listed value, more than double the previous record, which was set in 1999, at the peak of the dot-com bubble. When companies flood the exits in those quantities, they are not sharing the opportunity with the public. They are pricing the top and handing you the ticket. And if you want the precedent for what a spending cut does, it exists. In 2000, Coca-Cola needed 10,000 routers from Cisco. By 2001, it needed 2,000. That single species of decision, repeated across corporate America, collapsed Cisco's earnings and took the Nasdaq down 78%. The day one of the Big Four says the sentence, "We are moderating our investment." The Korean movie starts playing in English, margin calls, mechanical selling, emergency meetings, a finance official somewhere apologizing for products introduced without careful consideration. So 3 things to watch from the couch. A venue where your commitment has never once wavered, through recessions, through booms, through your family's repeated interventions. 1. Watch whether Seoul stabilizes, because the government is now throwing everything at it. And if a full state rescue cannot hold a market this oversold, that tells you how heavy the leverage still is. 2. Watch American margin debt and the leveraged fund flows, because that is the fuel gauge and it is reading fuller than at any moment in recorded history. And 3. Watch the capital expenditure lines of Microsoft, Google, Amazon, and Meta, the 4 numbers holding up the Western world, because Korea just crashed on the mere fear of a slowdown, and fear travels faster than any container ship. And the ending belongs, as ever, to you. A Korean newspaper this week reported something remarkable, that amid the cancelled dinners and the silent offices, the people who never bought any stocks are experiencing an unexpected sense of relief. An entire nation just rediscovered, at gruesome expense, the one financial position that cannot be liquidated, owning nothing. You have been running that strategy since birth. No margin, no leverage, no exposure. While a generation of bright, hard-working, motivated young people was force-sold at the bottom by a robot, you remained untouchable, horizontal, and 11 episodes deep. History will record that you were positioned perfectly, and only Meerkat and your family will know it was not on purpose. Somewhere in Seoul tonight, there is a version of you, same couch, same posture, same untouched savings account containing nothing, and he is, by the brutal mathematics of this month, the best-performing investor in the country. Meerkat is not telling you to buy anything, sell anything, or feel clever about anything. Meerkat is not a financial advisor. Meerkat is a small animal with a whiteboard, a national emergency teapot, and a paused episode he has now been away from for 11 hours, which is the longest commitment he has seen anyone in this audience's age bracket sustain. Please do not sue Meerkat. Like, subscribe, and go finish your own paused episode. It is the only portfolio you have, and Meerkat is pleased to report it is holding its value.